Hey guys, I'm putting the finishing touches on my totally free course that is a companion to my Stop Investing Like They Tell You book. It should be done by the end of this week. I'll put links below for access if you're interested. I'm really happy with how this course has come along, and I'm super excited to share it. So I wanted to put a clip from the first video lesson inside the course on YouTube so that you can get an idea of what's coming in the course. Like I said, this is just a clip from the first lesson. There are 17 total lessons inside this free course. Also, this process of creating this course has made me fall in love with video and the ability to artistically convey my message to those who are interested. So I'll be publishing new videos right here every week by May at the latest. So if you're interested, consider subscribing and then clicking that notification bell so that YouTube lets you know whenever I finally do start putting those out every week. I'm gonna go ahead and put myself out there and play that clip for you. Be sure and let me know what you think by clicking the like button or through the comments below. Can't wait to hear from you. Let's do this. Advisors want you to believe that they're the solution, that they can help you overcome this investment gap because they can help you control your emotions in times of chaos. Yet for over 20 years, Dalbar has been conducting their research and the results haven't really changed, despite advisors being aware of the problem and offering their assistance. Human emotion can be a powerful driving force, one that's extremely difficult to control. And those emotions, they aren't going anywhere. So this is where I want to take you through that mental exercise. Right now, you can just close your eyes and listen
to the soothing sound of my voice.
Or you can keep them open, suit yourself. Just be honest with yourself. That's what's important here. I want you to think about all the money you have in savings, all the money you have invested somewhere. I want you to picture it as a physical stack of cash or coins in front of you on the table or wherever you are. That image you have, it needs to represent all of your life savings, whether that's $100 or $100 million. As much as you can, I want you to feel that same emotional attachment to this mental image as you would your actual money. Every time before I enter an investment, I take myself through a similar exercise. The goal is to prepare myself and plan accordingly for any scenario that could happen. That way, I know what I'm going to do as one of those scenarios plays out. Even if it turns out to be the one I thought was the most unlikely, I'm prepared. So I don't react with anywhere near as much emotion during times of chaos. Are you ready? Have you envisioned your life savings in front of you? If you're struggling with that, feel free to use mine. Just give me a second to find my mental image. There. Now imagine it quickly drops, some unexpected market event by 10%. If you had $1 million, you only have 900,000. 10 million, now you have 9 million. You're probably prepared for that. It happens, right? When you took on those investments, surely you assumed that was going to happen at some point. Okay, so you're fine. What about 20%? Depending on how fast it dropped, maybe you start to get a little concerned. But then you remember that study and you say, you know what? I'm not going to be part of those statistics. I'm above average. Stephen even confirmed that for me. So I'm going to stay the course like a disciplined investor. It's those people who are freaking out right now, pulling out of the market, who end up realizing that 7% less on average per year. So I'm not going to do that. Sound fair? You're staying in? Well, as you might have expected for this example at least, it continues to drop. Now it's down 30%. At this point, statistically, most investors would begin to panic. And if you have a bad advisor, he or she's probably panicking too. If you have a good advisor, you might even get a comforting call from them. Don't panic. This happens. They fill you with some motivation, some words of inspiration. If you don't want to be in that statistic, you'll stay the course. You'll stay in. Did that do it for you? Were you comforted? Ready to stay on the ride? Are you fully prepared to stay in the market even though it's down 30%? Your $100,000 is now only $70,000? What if it keeps going? 40%, 50%, 60%. Every morning you wake up praying it's over, and then you turn on the news only to realize the market is suffering a significant decline yet again. There are no signs of relief. How do you feel? When do you just break? Maybe you didn't at 10, 20, or 30%, but when it's down 50%, I mean, you can see that it's half of where it was before. How much more of a beating can your future plans take? Were you planning on retiring in 10 years and assuming an 8% rate of return? Because that's probably not going to happen now. Now you're realizing that a 0% return or worse over that time is possible. On the one hand, your advisor is begging you to stay the course. Feel free to ignore the fact right now that if every one of their clients did pull out of the market, they'd be out of a job. Sounds like a little conflict of interest. Beware the moral hazard. On the other hand, you realize you can stop the bleeding. It is within your power. You can make the pain go away. Take a moment to regroup and at least be happy with the fact that you still have what you do. Sure, you want that $400,000 to go back to $1 million. But you need that $400,000 to hit your bare minimum retirement goals. So do you risk it falling below that? Or do you just pull it out now? Is it worth the stress of just sitting idly by and potentially watching it drop another 200,000 and maybe even staying that low for decades? Forcing you to work through your planned retirement? You get the idea. No matter how strong your conviction today, at some point, almost everybody would become disconnected with the fact that the market very well may begin to recover tomorrow. That doesn't matter anymore. You just stop caring. You want out. You get out. At least you have your 400,000 or your 40,000. At some point, emotions are more impactful than any advice from your advisor. When is that point for you? When do you break? If it's not the 60% mentioned here, is it 80%? 90%? We're talking about your life savings. Would you not panic if you were only getting a dime for the dollars you used to have? These scenarios are not impossible. An 89% drop has happened before. Not recovering for decades, that's happened too. Even if you are super strong-willed and think you could have stayed the course this whole time, I think maybe an even more important question to ask is, would you have been wrong to break? I know that may sound contradictory, but if you're adhering to that traditional stock and bond only portfolio, I think your emotions may be onto something. Maybe deep down inside you recognize some of the problems with modern portfolio theory. We'll discuss the biggest one, the most significant logical fallacy. Thanks for watching all the way through. I hope you enjoyed it, and I hope the information was helpful. I'd love to hear from you in the comments. Be sure and let me know what finance or investment related topics or questions you'd like to see addressed in a video like this. If you're interested in the free course, check it out in the link below. Don't forget to subscribe, and hopefully in the near future, I'll be seeing you here more often. Until then, take care.